The various investment asset classes that one needs to invest, basically equity and debt and maybe commodities. Now, one of the important asset class that one invests into is debt. In debt, one has variety of different options, from fixed deposits on one side to debt mutual funds on the other extreme. Why does one need to look at debt funds? That's what we're going to look at today in this video. Now, fixed deposits are easy instruments. They are debt instruments. What do we mean by debt? They give you a fixed return and they are reasonably predictable, even if they are low. Fixed deposit in a bank or a fixed deposit of a corporate or a bond or a debenture are all debt instruments and reasonably easy to predict, easy to operate, so on and so forth. There is another instrument which is called a debt mutual fund, and these are funds that invest investors' money into debt instruments that generate a fixed return. Unfortunately, retail investors don't understand this investment very well. Debt mutual funds have three components of risk that one needs to understand. The first risk is called the interest rate risk. The interest rate risk is nothing but the fund manager invests in companies and government securities with the understanding that the interest rate is going to move in a certain direction. Now, it's likely that the interest rates may move in the direction. Sometimes they don't always move in the direction. They may move in a different direction. And when something like that happens, the fund has an impact on that. This is called the interest rate risk, because interest rates are not always easy to predict. The funds suffer from what is called the interest rate risk. Second is the credit risk, or the default risk as it's called. When fund managers invest in, say, 100 different corporate papers, it's likely that they will choose different companies from the highest, safest companies to the not so very safe company. Because all monies can't go to the safest of companies, because then the rate of return that one gets is very, very low. So you will need to combine it with securities that provide you slightly lesser security but a slightly higher interest as well. So that's the play that the fund manager plays. Now, in this, sometimes it so happens low security firms may go defunct or default, and there lies the credit risk that the fund will suffer. If they take up a paper and that company goes bust, then to that extent that fund will suffer that element of. The third risk is what we call the mark-to-market risk. As in equity, any mutual fund needs to recognize the daily changes in the market price and the interest rate and the pricing. So to that extent, the price of debt fund will change on a daily basis based on external environment like market expectation of interest and so on and so forth. So these are the three risks that any debt mutual fund faces. Having said that, one needs a variety of basket of investments that one needs to put in so that he can reasonably diversify their portfolio towards long-term approach. Now, having said all this, what is the case for a debt mutual fund vis-a-vis a fixed deposit? Option 1. If one is to stay invested for a 3-year period, the returns that one gets from debt funds get a lot more tax advantage than what one would have in a plain simple fixed deposit. So to that extent, there is a tax arbitrage that at least one enjoys. So if you are on a 30% tax bracket, you must certainly consider debt mutual fund as an option as compared to an FD. Second, fixed deposits are exposures on one singular company. Something bad happens to that company, the entire amount is gone. In fact, fixed deposits in corporates are unsecured loans. In banks, they are secured to the extent of at least 5 lakhs, but in companies, they are completely unsecured. So if something happens, you get nothing out of it. On the other hand, the mutual fund debt funds invest in a variety of different instruments within the debt category. So even if one of that security goes bust, it accounts for not more than 3 to 4% of your overall portfolio. So to that extent, the risk gets largely mitigated because the fund manager diversifies the portfolio. That's the second. Third, if you put a 3-year FD and go back at the end of 2 years or 2.5 years and you want your money back, you will get your money back, but you will be charged a penal interest for foreclosing that FD before time. On the other hand, in debt mutual funds, there could be a mandatory exit load period for a shorter period of time, but beyond that, most debt funds offer open-ended funds, so you can exit much earlier and get your money quickly into your bank. So these are the three cases why one can consider debt funds as also an option in your fixed income portfolio. While it is a difficult investment to understand as compared to an FD, I think these 3 points make a very, very strong case for somebody to consider debt funds as part of their portfolio.